Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge funds, portfolio managers, family offices, RIAs, and individuals. We're here today with our friends from Horizon Kinetics. We've got Peter Doyle, who's been on with us at least once before, maybe twice, and Brandon Colavita, here to talk about blockchain development and the blockchain development sector. Welcome, guys. Good to have you on.
Thank you, Gary. Nice to be here.
Yep, very good to be here.
All right, guys. So I want to ask you about the new ETF you've started, but before we do that, let's just talk about the origins of the blockchain, and let's talk in basic terms. And here's why I want to do that. We did a call with Horizon Kinetics and Block Tower last year, and my dad was on the line. My dad's a smart guy, but people of his generation aren't normally so familiar with the blockchain and with cryptocurrencies. And so, I was constantly trying to translate what was being said for maybe a smart but lay audience. Let's talk about the basics here. What are the origins of blockchain, and how is that technology tied to crypto?
So I'll jump in here, and Gary, I think I was invited mostly as a courtesy, and you're going to hear Brandon do most of the speaking today. But as far as I know, I think the first blockchain really came about in late 2008 with the development of Bitcoin, and Satoshi Nakamoto did it. And you can correct me if I'm wrong on that, Brandon, but that's the first that I've heard of it. And essentially what a blockchain is a type of database that is a public ledger for recording transactions. So if you thought about owning a basic business, you want to know what you're buying and what you're selling and keeping track of that, and that's what a blockchain does. Brandon, you want to add anything to that?
Sure. It's a combination of a lot of technological developments that have been growing for a long period of time. We could go back to the creation of timestamps for digital transactions, and then you move forward to reusable proof of work, and we don't have to get into that. The whole point here is that we got to a point with Satoshi Nakamoto's white paper, the original white paper referencing Bitcoin and kind of the protocols that underlie that, and that was the first instance of an actual applicable blockchain. And that's why that the two terms, blockchain and cryptocurrency, get tied together so frequently, is that Bitcoin and the transfer of monetary value was actually the first application of this technology. And that's actually kind of how we got involved looking into the technology to begin with. We were fascinated with cryptocurrency, with Bitcoin specifically, how you could have a limited issuance currency that could be distributed and maintained in a decentralized format. So when we started looking at other ways that this could be applied, and obviously there's been a lot of companies that have been utilizing this, we saw just an enormous potential for companies that I guess they're operating in new industries that are tied directly to cryptocurrencies, but also for companies that have operated for a very long period of time. Just like that, a lot of these companies were able to utilize the internet as a technology to improve their businesses, we think that they can utilize blockchain technology to improve their businesses. And if we really want to get into the basics of what a blockchain is, it's kind of just a new system to record transactions and information. It's a distributed peer-to-peer ledger that allows for immutable transactions. And the whole term of blockchain comes from the idea of how this data is consolidated. These groups of transactions are grouped together into blocks, and then they're linked together chronologically over time so that you can know the entire history of whatever information or asset that you're trying to record, all the way back to the first record of any transaction. So this creates a situation where participants, and they're sometimes known as miners or validators, but they can verify the ownership and the history of any sort of movement of this asset over time, and it creates a lot of opportunities for these companies. And I'll stop there. We'll keep it simple for now, but we can get a little bit more in depth as we go on.
All right, Brandon, that's a great answer. For the people on the call who are maybe Bitcoin or cryptocurrency novices, I'm just going to sum up, Brandon. I think what you're saying is we should think about the blockchain as just a digital ledger. Just like if we go back 100 years, an accountant might have a notebook where he records all of the transactions for a business. The blockchain is simply that, but it's in public and can't be changed. It is simply a ledger. Just like we'd have a paper ledger for a business 100 years ago, we have a digital recording of transactions. And I think your second point was that cryptocurrencies require the blockchain, but the blockchain has applications that might not, that would be for things other than cryptocurrency as well. Is that right?
I think that's a very good way to describe it. I will add one thing in that there is no centralized version of blockchains typically. It's maintained by all participants, and each one maintains their own ledger, and they discuss changes. And to actually enact changes, the authorized participants, and sometimes public blockchains, anybody's authorized. Sometimes there's private or permission blockchains where only some people are authorized. But in some point, you come to a consensus to update all of your records to match one another. So there's no central point of failure in a lot of these blockchains that we're very interested in.
Right. So some sort of event that might take a server offline or create a problem for an individual business, the blockchain is distributed and therefore it's not subject to one attack in one place, right?
That's correct. And not just attacks, but ways to manipulate. I mean, one of the interesting points of Bitcoin is that there is a limited issuance that's built into the code. And you compare that to a centralized system of fiat currency like the US dollar, where any given day they could print more and manipulate the system for, you know, the central government's benefits. And because there is a consensus mechanism that, you know, that underlies this technology, you have to go through and actually have approval before you make any sort of changes to these, whether they're transaction-based or changes to the protocol.
Right. And, you know, Brandon, I think the key issue that you're talking about here is whether something's transparent or not. So for example, we do vote for our representatives, and when our representatives in Congress overspend, the Fed has to monetize that, and we print another few $1 trillion of currency. And the end result of that is going to be the reduction in purchasing power for the rest of us who are holding US dollars in the case of the United States. And technically we take part in the process, we vote for those representatives, but now imagine a situation where every time Congress wanted to print another few $1 trillion, they put that up to a vote. And everyone in the United States who was holding dollars got to say, yeah, I'm okay with you debasing the value of what I own, reduce the value of my savings account or the assets that I own, or no, don't do it. And the point of the blockchain is all of that is public. And if you want to make changes, you need to get buy-in, and people have to explicitly agree to the specific thing that is being discussed, right? Is that the point that you're making?
Yeah, I think that's a great way to put that. And again, that's the general sense of more of a public blockchain. And we use Bitcoin as an example because it's the most well-known utilization of this. But there's a lot of different ways to kind of adjust this technology to the benefit of individual companies that, you know, may not want to have completely public systems, but they see value in the way of transacting and the information recognition that goes along with this.
All right.
And Gary, in keeping with your comment, you know, it was born out of the financial crisis. And I think Satoshi Nakamoto recognized the debasement of money, and he said that we need a better system, and hence he started working on the Bitcoin blockchain.
Yeah, and you know, Peter, I'm really glad you mentioned that, because almost a year ago at Deep Knowledge Investing, we wrote a response to Nassim Taleb, who put out a white paper saying that he thought the value of Bitcoin was zero. We addressed his arguments head on, but one of the key ones is that all fiat goes to zero. right? All empires end and all currencies end with overexpansion of the money supply. It happens the same way every time. It all goes to zero. And so I know one of the things that Horizon Kinetics has said on prior calls with us, and Chris Bell has said this as well, take 50 basis points, 0.5%, 1% of your portfolio, of your assets, and put it in Bitcoin or cryptocurrency, something like that, because why not have a small amount of exposure? If it doesn't work, okay, you've lost a little bit of money, but if it does work, that's a lot of portfolio protection.
Yeah, we felt that you needed something outside the system, and it's kind of an insurance policy. And from the time we first got involved with it in 2015, early 2016, we were saying you don't need a big position. Again, 50 basis points, maybe 1% position of your entire wealth, and that 1% position, in theory, could actually hedge a big chunk of your financial wealth if the traditional financial system started to melt down, which looks increasingly more likely every day, actually.
Right. I completely agree. That's a great point. So let's talk for a minute about the new ETF that you guys have come out with, because I want people to understand what you're doing. Now, I know Horizon Kinetics has a crypto fund. We've had Block Tower on. Michael Busella made some great points about their crypto fund. That's not what this is, right?
That's correct.
All right.
And Brandon is going to get down into the weeds, since he's doing the day-to-day work on that, and really has a nice story to tell.
All right, let's go, Brandon. What are you guys working on?
So we have an ETF that we're applying a fundamental value methodology to a new and growing space. And we get, the question a lot of how a value manager gets involved in what's viewed kind of as a growth technology. And we're lucky to have Peter involved as the creator of the world's first internet fund back in 1996. And, I guess I wasn't here at this point, but I will say that they were just as contrarian and value oriented at that point as they are today. So the methodology has continued. So what we see here is we see an enormous opportunity in the application of this technology for both brand new firms and brand new industries and companies that can utilize this to either expand their scale or expand their margins in some ways by increasing the efficiencies of kind of what they do. So we're looking for companies that are either benefiting through direct or indirect exposure to the issuance, the facilitation, and the trading or the administration of digital assets. Now, we use Bitcoin as an example. That's not the only digital asset. Kind of anything can be tokenized and can be transacted through a blockchain. And over time, we believe that that's going to be the general movement. We believe that this is a better system to move asset value from one place to another. It's traceable, it's secure, it's immutable, and it's something that we're just seeing the early stages of. So when we're looking at this, we're looking at a few different industries that have long-term applications that will lead to additional value for our investors.
Okay, so I know you guys might have some restrictions about talking about specific companies, but I have looked on the website. I've seen a list of the companies that you guys own. If you can talk about individual companies, great. If not, let's give people a sense of the kinds of companies, the industries you're looking at, right? Who's benefiting from this shift to the blockchain, this use of a digital distributed ledger?
Hey, Gary, can I just jump in? Can I just jump in here 1 second before Brendan asks that question? So, Brandon gave me credit with starting the first internet mutual fund, but I want to say, and coincidentally, a neighbor of mine out in Quogue, New York, actually was the one who gave the idea to my brother, and we actually ran with it. And part of success in life is really just showing up and get, we don't know everything about what's going to develop in the future, obviously, but part of it is you need to be there. And if you see something coming, get involved and start offering a product that's basically potentially can capture this development in technology. And that's really what we did with the internet fund. And that's what we're doing here with the blockchain fund.
Makes sense. Great. All right. So do you guys want to talk about the kinds of companies you're looking at? What kinds of industries are benefiting from the shift?
Sure. So I'll start off by saying that, we're probably not the first fund that's related specifically to this technology, but we're doing so in a way that is as contrarian as kind of the rest of Horizon in our applications. And we're not willing to risk the capital of our investors just to get 100% exposure to blockchain applications that are already fully developed. We take a perspective view. We're looking 5 to 10 years down the line and saying which companies and which industries will have end staying power in the use of this and will actually be able to build off of this instead of just maybe having a short-term run that's tied to a buzzword in the industry. So when you look at a lot of our names, we're investing in a lot of companies that are profitable already, that have incumbent businesses that they're going to expand their efficiency through the use of this. So the first group of companies that I'd like to highlight are financial exchanges. And these are companies that are financial marketplaces that, gain revenue or earn fees on trade volume, listings, or the data on the assets that they service. And with this idea of tokenization, where more and more assets will be able to be transacted in a tokenized form or through a blockchain, we think that these companies are actually going to be the biggest beneficiaries of this movement, because as more tokens are created, we're going to need more robust systems to connect digital assets and their purchasers. So, there's going to be, with blockchain, there's typically a use for peer-to-peer trading, but the sheer scope and the variety of the assets that we'll have available to purchase are going to require some more liquidity, and you're going to need some sort of centralized marketplace to actually move those assets. And on a second front, these companies are not just the beneficiaries of the ending digital assets, of a new way of, a new asset class that you can exchange. They're also updating their back office to some sort of distributed ledger or a blockchain type ledger, where they can actually remove a lot of the time, a lot of the resources, and a lot of the capital that's tied to the clearance and settlement after your initial trades. And a lot of people, there's T+2, and we can get into all of that, but there's a lot of work that goes into these companies and connecting brokers and verifying that people have the assets and the money that they're trying to transact across each other. That takes time, that takes resources, it takes, reconciliation. And when you have a distributed ledger or a blockchain where you have all of this available in front of you, you can completely cut out a lot of the intermediary costs and work that gets done to actually facilitate and settle these transactions. So the next group of companies that we focus on are, it just shows kind of how different the applications can be, but we're focusing on some data and defense companies. With blockchains, especially the public ones, there's a treasure trove of data available to dig through and to see how things move. And there's a lot of information to comb through. And I'm sure that there's a lot of people that have tied cryptocurrencies to illicit transactions and illegal workings. That's not something that we really believe makes a lot of sense, because when you have public blockchains and you can see where assets move, from one wallet to another wallet, all you have to do at some point is to tie these companies and these addresses to one on or off ramp. And if you can tie one individual identity to a wallet, you can kind of see a lot of different information on who they do business with. And some of these data and defense companies have already gotten started in monitoring the dark web and policing bad actors, so that, we have a more secure and a more, a more government or more regulated market with some of this. There's also the movement towards private or permission blockchains for supply chains, which these companies have been involved with. So you can see that it's not just financial aspects that are sometimes tied to this technology. You can also, apply it to different ways.
I spoke with somebody last week who was very concerned about the use of cryptocurrencies for things like running drugs or for sex trafficking. And, my response was, that's the worst way possible, the worst way imaginable to finance those kinds of businesses. I mean, it's basically like saying, we're a drug cartel and we're going to put a ledger of all of our transactions up in public for public scrutiny, right? I mean, it all becomes traceable. My biggest concern with the blockchain is not that there will be illegal activity on it, because the public nature of it discourages that illegal activity. My biggest concern is the loss of privacy if all of our transactions are available.
Sure, and that's a good point that that a lot of people bring up, and that's why public blockchains are not the only way to apply this technology. There's also permission blockchains, where instead of having anyone who is an authorized participant who can verify all data, you sacrifice some decentralization, and you can have a permission system where maybe instead of having again, you or me who can mine Bitcoin, maybe we have a consortium of banks that issue a stable coin or their own token between each other, where they can verify deposits, which for the most part they already have to do in some way, but you can actually transact even faster. And there's some crypto financial companies that have already created stable coins and tokenized deposits within like a consortium of banks, where they can still maintain privacy and still transact in a better way using this technology. Now we can get into zero knowledge proofs, but I think that's still, they're still working on that, where you might actually be able to have public blockchains that still maintain a high level of privacy. But I think we're going to have to monitor that as this technology develops. Again, we're still in the infancy here.
All right, let me go back to something you said before, because you were talking about the various kinds of companies that benefit from use of the blockchain. Are there limitations on that? Because part of the issue with the public blockchain is there is a limit to the number of transactions that can be added a day. Right? You can't have unlimited additions to it and still maintain the distributed ledger at a size that individual people can run nodes, right?
Sure. And there's not one individual protocol. So when we look at, some scalability, I mean, we personally at our firm, we love proof of work. We think it adds to a high level of security to the underlying transactions. It's public, it's distributed, it provides pretty much everything we like with Bitcoin. But again, there's different applications where maybe sometimes, and this is to the choice of the participants, you can sacrifice a level of decentralization for greater speed, like with authorized participants, instead of having thousands compete with each other. Maybe you have a certain authorized amount that can operate within their own blockchain. There's other protocols involving proof of authority, proof of stake, which may, they have their issues. I guess it remains to be seen how these will play out, but the technology is flexible. So just because some things are not available or efficient right now does not mean they won't be a more efficient solution 5 or 10 years down the line.
Okay, makes sense. Let's also talk about asset correlation. So again, I know Horizon Kinetics has a crypto fund. That's not what you guys are doing here with this fund, right? And so, but isn't there a great degree of correlation, right? What we've seen recently is because the Fed has been hiking rates and the market has come down, we've seen this risk on, risk off function, and it's taken down the crypto market. And as the dollar price of different cryptocurrencies, especially the apex cryptocurrencies, have come down, the value of the companies that are serving that community have come down as well. The stock prices have gotten crushed. So in some way, what you guys are doing is completely different, but isn't it highly correlated? How do you maintain some sort of value separately from cryptocurrency pricing? Does that make sense?
Sure. Actually, this is one of our differentiation factors, is that There is not a large amount of our fund that is directly related to what people consider the typical cryptocurrency industry, where it's cryptocurrency mining and hosting. We do see value over the long term for these companies, but you've seen, obviously, they can move even in an even greater volatility than the underlying cryptocurrencies that they validate. I don't think that the portfolio is meant to track crypto in any given way. It's not how we built it. We built it to support the underlying infrastructure of digital assets as opposed to investing in specific digital assets. We have ways to invest directly in digital assets. So we created something a little bit different here. And what you'll notice with our businesses is that the application of blockchain technology is kind of just an enhancement of their current businesses. So look at exchanges, and some have gotten involved in futures and futures and options trading along with cryptocurrencies, but a majority of their business is still, the equities, the typical derivatives that we're familiar with, futures on ETFs, and these still can be updated to incorporate blockchain, and we just haven't seen it yet. So there are incumbent businesses that are tied to cryptos, but they're still early. So again, we're viewing this portfolio as both more limited upside, but more limited downside in comparison.
Okay, that makes sense. Peter, were you about to say something?
Yeah, I was, Gary. Correlation is looking in the rearview mirror. And, the globe was very correlated to Google at one point, right? And Google went on to flourish and thrive, and the globe went out of business. So it's there's going to be a shakeout, and I think most people still don't fully understand what is developing in this industry and how important it's likely to be in the future. So they are trading it right now as a risk on, risk off asset, and there's going to be some substantial winners, and it's going to be a multi-trillion-dollar industry, probably the biggest in the world in the future. And you're going to have to live through these drawdowns and these crazy times. But if you take a long-term view and you're placing your bets in sensible areas, you're likely to do quite well as an investor.
And I think you guys are smart to talk to investors and potential investors about time frame. One of the biggest issues I see in the asset management business is a mismatch between the way investors are evaluating a fund and the time frame being used by the fund managers.
100%. I mean, we take a long time horizon, and if you look at the most successful money managers, the overwhelming majority really have a high level of concentration, and they actually have a very long time horizon. And their portfolios tend to naturally undiversify, and they let their winners win. You can't make 100x on an investment and hold it 2 weeks. It's just not the way it happens. Generally, something that goes up 100 times, you held it for a decade or more, and you have to have that patience. And there's going to be many times when that asset gets drawn down, and people are, discarding it like it's worthless, but it's not worth it. It's worth quite a bit.
Yeah, that's a great point. I know there was a period when Raji Kabaz and I were running Silver Arrow, where people would ask about our investment process, and we would tell them, we were evaluating companies on a 2 to 5 year time frame. So sort of that, medium to long term. And every now and then we'd have somebody ask us, well, can you send us daily returns? And our answer to that was no, we're not sending you daily returns. It's not relevant. And if you're going to evaluate us that way, that's not a match for our investment style.
Yeah, that's been one of the challenges for us as a firm. We're trying to educate people long term. You're trying to capture the business returns of the underlying companies that you're invested in, and that's not going to happen over a 2-month period of time, a 6-month period of time. You need that to play out and let the businesses compound to your advantage. But a lot of people just don't have that patience, or they don't feel confident in the homework that might have been done. If you know what you own and the stock goes down, you should be extremely happy as you're a long-term investor if you have the ability to buy more.
Yeah, that's always our approach as well, but it can be difficult to exercise that discipline unemotionally for a lot of people. That's a tough one. By the way, for everyone who's listening in, we're so glad you're here on the call. If any of you have questions for Peter and Brandon, feel free to use the chat feature. and send your questions in. Manuel will see them and will forward them to me, and we'll be happy to take questions from the audience. So if any of you have things you want to know, send them in right now. Peter and Brandon, let me ask you a different question. One of the questions we put in the advertising materials for this is the implications of the tokenization of everything. Brandon, earlier on this call, you talked about tokens. We've got people on here who aren't going to know what that is. Can you guys help explain what tokens are? What does it mean that things are being tokenized? And then what are the implications of that?
Sure. So again, I hate to keep on going back to this Bitcoin example, but there are ways to transact with whether they're securities. So we are very comfortable with going to an exchange or a brokerage and buying an equity or stock and going through their process. And, it's all digital for us. That's all we're seeing. We're not receiving paper certificates or anything. There are ways to, instead of rely on these centralized intermediaries in a lot of ways, you can actually have these securities exist in a new format, where instead of storing physical securities, you can actually have things and ownership that's represented through a token. And this can be transacted through a blockchain with different amounts of participants and protocols. And it's just a new way to transact with some of the assets that we know. And it increases the level of security in some ways. Like I mentioned before, when things are distributed, there's a level of increase in efficiency off of the reconciliation process. You can have some level of decentralization in a lot of these ways. So a central authority cannot manipulate or charge excessively high fees on these transactions. There's a level of transparency, and then there's access, where you may not actually have to be connected to any sort of central banking entity to get things done. So equities as a financial asset are an example, but we can also use this for tangible assets like real estate, where some of these transactions are exceedingly large, and a lot of the everyday retail investor may not have access to these large investments, because you can't pool. You'd either need to pool together your money to get access to it, or you're just not even in those markets. And tokens create a situation where you can have a divisible currency or a divisible asset that can be broken out and traded within a liquid fashion that you're not seeing right now. So when we talk about the tokenization of everything, we're talking about assets that we know, especially financial assets, moving in a different system. And then we're also talking about tangible assets that may not have been easily transacted before, that can be moved towards a digital representation and can be moved in a transparent and secure format through there. There's a lot of different applications to that. You can have, pretty much anything can be moved towards a token, where it just represents some level of ownership of an underlying asset.
Okay. And that, I think that last part is the most basic, simple way to explain it to people. Just like if you're going somewhere, you might get a ticket or a receipt. A token is nothing more than a digital receipt certifying that you've either entered into a contract, or that you own an asset, or that you have admission to something. It could simply be a digital ticket.
Sure. And then there's also the idea of funding companies. I think there's a lot of people who've probably heard about the ICOs, but what if companies, instead of issuing debt that is backed by the assets of the company, what if we could actually tie tokens to a specific revenue stream, where instead of funding a full company, we're funding a specific project at the company, and maybe you get some sort of return off of that asset, or you get the asset itself and you're just prepaying for a specific product or service. There's a lot of different ways that we can actually create or utilize this technology to improve the capital structures of businesses and really just the movement of asset value.
Yeah, and what you're talking about is simply the 2022 version of something that's been done for decades. For instance, companies have been factoring the receivables for years, which is a fancy way of saying that instead of waiting for their customers to pay them, they will sell the receivables to a third party for a small discount. And they get paid right now, and they are alleviated of any uncertainty that they won't get paid. And the factoring company, they take the time risk and the non-payment risk, excuse me. So we've seen stuff like that for years and years. What you're talking about is simply a digital version of a practice that's been around for decades.
I think you put this in a much better way than I could. So I appreciate that.
Oh, my pleasure. All right, guys. So for people who are interested in what you're doing or want to read your research or want to know more about this, where do they find you? How do they learn more?
So you can find more information about this ETF at horizonkinetics.etf.com. But we're also very comfortable posting our quarterly commentaries and our research just on our general Horizon Kinetics website. I recommend to anybody to check our website, as frequently as possible. We put our research out there, and we always want to promote a conversation. So we've actually moved forward, and I guess we've digitized our content as well. We're very frequent on the Twitter sphere, where we're publishing observations on almost every other day, I'd say, and they're just quick hitting bullet points that bring kind of our investment mindset to I guess a public forum. And there's a lot of different ways you can get access to it, but those are the two best ways.
Yeah, I love that answer. By the way, one of the people who's in the audience for this call is Horizon Kinetics National Sales Manager, Chris Bell. He's also a member of the Deep Knowledge Investing Board of Advisors. You should follow him on Twitter. He is at CDB Kinetics. So CDB KINETICS on Twitter. My favorite thing that Chris puts out are his observations. He numbers them. Lately, they've been very much on issues like inflation, where I think you guys have been leaders and early on the call. And we've even had on-air discussions with your people on that. So for anyone listening in, check out Chris Bell on Twitter, and you definitely want to be reading what he's writing.
And I'm not going to take credit for that in the least bit, Gary. Thank you. I'm literally just writing down what Peter and Brandon tell me to. They're the ones that are creating all of that. But thank you.
Good enough. We're always happy to read whatever you guys are writing, whoever it's from. And for people listening in, that was Chris Bell chiming in. All right, guys. So I think we're about ready to wrap up. Peter, any final comments from you?
No, Gary, I think you touched on the main points, and I'll just reiterate what Brandon said. I think the best way to get to know us is to read some of the research, and if you don't find what we say logical and consistent, then it makes your decision easy. But I think we're early here. I think this has great potential. I think Brandon's going to do a fantastic job with the fund. He's really immersed himself in understanding where the world is going. And now it's just a question of basically biding our time and letting it play out.
All right. Terrific, everyone. So I want to thank Chris Bell, Peter Doyle, and Brandon Colavita from Horizon Kinetics, talking on the blockchain. Guys, thanks so much for your time today.
Thank you, Gary.
Thank you.